All right, let's jump right into it. We are tackling one of the most common moves in all of DeFi, providing liquidity. But here's the thing. That simple deposit button you click, it could be triggering a pretty significant and, often totally unexpected tax bill. Let's break down this hidden financial event.
So picture this. You've decided to put your crypto to work. You've got your ETH, you've got your USDC, you find a good pool on a decentralized exchange, and you hit Add Liquidity. It feels just like a deposit, right? Like you're just moving money around. But the huge question we're diving into today is, from the IRS's point of view, did you just sell your crypto without even knowing it?
You know what? Let's just get straight to the punchline. The consensus among tax professionals, all based on current U.S. law, is that yes, providing liquidity is a taxable exchange. Now we're going to spend the rest of this explainer digging into exactly why that is, what it actually means for you, and how on earth you're supposed to calculate it.
So here's our game plan. First, we'll unpack the whole idea of this hidden tax event. Then, we'll get into the legal weeds a bit, bailment versus barter exchange. After that, we'll look at the specific law, IRC Section 1001. We'll walk through a real calculation, talk about what happens when you pull your money out, and finally, touch on some other tricky spots and what the IRS has said recently.
Okay, so this is really where all the confusion begins. It's this mismatch between what the user interface says and what's actually happening on a technical and legal level. DeFi platforms, they use these friendly words like deposit, but under the hood, the blockchain is actually executing a very complex exchange of property. Let's peel that back.
And that brings us to the core legal argument. So on one side, you have this idea of a bailment. This view argues it's a non-taxable thing. It's kind of like checking your coat. You're just parking your assets for a bit, and the LP token you get back is just a digital clean check. But the much, much stronger argument, and the one tax authorities are leaning on, is the barter exchange. This says you've actually traded your ETH and USDC for a brand new, fundamentally different asset, the LP token itself.
So why does that barter exchange argument carry so much more weight? Well, the answer isn't buried in some DeFi white paper. It's right there in the United States tax code. This really isn't a matter of opinion. It's about applying these really old, established legal principles to brand new technology.
And here it is, Internal Revenue Code Section 1001. This is the bedrock of the whole thing. It clearly says that any time you have a sale or other disposition of property, you must recognize, which is just tax speak for calculate and report, any gain or loss. And since the IRS has officially classified crypto as property, this rule applies directly to every token you own.
Okay, so how do we know if what we did was a disposition? For that, we turn to the Supreme Court, believe it or not. In a landmark case called Cottage Savings v. Commissioner, they created a test. The test is whether the properties you exchanged are materially different. Do the things you got back give you legally distinct rights and economic realities from what you gave up? If the answer is yes, then boom, it's a taxable event.
And this table just illustrates it perfectly. It shows exactly why an LP token crushes the Cottage Savings Test. Let's just walk through it. Holding ETH gives you a claim to, well, that specific ETH. But an LP token, that gives you a claim to a constantly fluctuating percentage of a shared pool. Holding ETH by itself generates zero income. The LP token, on the other hand, gives you rights to trading fees. And the risk profile? Totally different. The LP token introduces this whole new, unique risk of impermanent loss. These are, without a doubt, legally distinct entitlements.
Okay, so we've established the what and the why. Now let's get down to brass tacks and talk about the how much. How do you actually go about calculating the tax liability here? This is the moment where that hidden event turns into a real number that has to go on your tax return.
It's really just the standard three-step recipe for any capital gain. First, what were your assets worth at the exact moment you deposited them? That's your proceeds. Second, what did you originally pay for those same assets? That's your cost basis. And the difference between those two numbers is your capital gain or loss. Simple as that.
Let's run through a concrete example from the source material to make this real. Let's say you have 10 ETH that you originally bought for a total of $10,000. And you also have 20,000 USDC that you got for $20,000. Today, right now, the moment you decide to deposit, ETH is trading at $2,000 a coin. First up, let's calculate the proceeds. Your 10 ETH are now worth 20 grand. That's 10 times $2,000. And your 20,000 USDC are worth, well, $20,000. So your total proceeds from this sale are $40,000. That's the fair market value of what you just gave up.
Okay, next step, your cost basis. This is just what you originally paid. Nice and simple.
In our example, that's the $10,000 for the ETH plus the $20,000 for the USDC. Add them up, and you get a total cost basis of $30,000.
And finally, the big reveal. You take your $40,000 in proceeds, subtract your $30,000 basis, and you are left with a $10,000 capital gain. This is the hidden tax event. You now owe tax on that 10 grand for this tax year, even though you never saw a single US dollar and all your value is still locked up in DeFi.
But wait, the story doesn't end there. The act of putting your tokens in the pool is one taxable event, but the act of taking them out, well, that's a second, separate one. And this is where that dreaded concept of impermanent loss becomes really, really important for your taxes.
So, from a tax perspective, impermanent loss means absolutely nothing while your funds are just sitting in the pool. The IRS basically sees it as an unrealized, on-paper fluctuation. It only becomes real, something you can actually claim on your taxes, at the exact moment you withdraw your liquidity. In other words, when you dispose of your LP token. When you do withdraw, you're making another sale. This time, you're selling your LP token. Your gain or loss is the difference between the fair market value of the assets you get back and the cost basis of that LP token, which, remember, was the $40,000 value when you first deposited. So if you've suffered impermanent loss, the value of what you get back will be less than $40,000, which finally realizes that loss in your tax math.
Now this creates a really dangerous trap. It's called tax asymmetry. Imagine you deposit in December and you realize that $10,000 gain. You owe tax on that for year one. Then, in January of year two, the market goes haywire and you suffer major impermanent loss and you withdraw for a capital loss. Well, too bad. You can't go back and change your year one tax return. You have to pay the tax on that gain, and your new loss in year two can only be used to offset other gains in year two, with some pretty strict limitations.
The complexity doesn't just stop with getting in and out of a pool. So let's quickly cover a couple of other common DeFi transactions, and, importantly, clarify what the IRS has said about all this stuff very recently. This little table sums up the broader tax landscape pretty well. We've confirmed deposits and withdrawals are taxable sales. But look at a couple of other key points. Claiming your fees is usually treated as ordinary income. And even something as simple as wrapping ETH into WETH is, from a conservative view, a taxable sale because you are technically exchanging one token for another.
Now, you may have heard some recent news from the IRS, specifically Notice 2024-57. Let's be absolutely crystal clear about what this means and what it doesn't. It means the IRS is temporarily letting brokers off the hook for reporting these LP transactions on the new Form 1099 DEA. It does not, I repeat, does not mean these transactions aren't taxable. The responsibility to track, calculate, and report these events still falls 100% on you, the taxpayer.
And that really brings us to the final takeaway. DeFi might be decentralized, but tax law is anything but. The rules are complex, for sure, but the economic substance of these transactions pretty clearly points towards taxable events. And, ignoring this reality could lead to some very significant unreported tax bills down the road.
So, we end on this question. Now that you understand that your deposit is almost certainly considered a sale under current law, the only question that really matters is a practical one. Are your records good enough to actually calculate and report these hidden events accurately? Because in the world of crypto taxes, what you don't know can most definitely hurt you.